Hi everyone, welcome to the Sharesight channel. In this video, I'll show you how to run the unrealized CGT report, and I'll give you a few scenarios on how to use this report for tax planning before the end of the financial year. Before we begin, don't forget to like this video and subscribe to our channel. Follow us on our social media at Sharesight for more product updates. Just a reminder that the information in this video is for informational purposes only and should not be considered as a tax planning advice. Always consult with a qualified tax accountant for advice tailored to your circumstances. Alright, let's get into the report. If you go to the Reports tab, you can find the Unrealized CGT report under the Tax and Compliance section. There are three settings in this report: a date option, advanced options to enter losses carried forward amount, and the option to change the sales allocation method. How this report works is simple. It calculates your unrealized capital gains tax based on the date you select. For example, if I set the date to the end of the financial year, the report will create a hypothetical sale for each parcel of shares, starting with the oldest ones first, because the sales allocation method is set to FIFO, or first in, first out. Next, the report calculates the gains for each parcels by considering the cost base and the latest market value. Since the report tracks when you bought each parcel, it categorizes the gains into short-term gains, long-term gains, or capital losses. Once we have the total amounts for each category, the report then calculates your overall capital gains, factoring in any applicable CGT concessions or losses carried forward. Changing the date or the sales allocation method will affect the overall capital gains. So I suggest experimenting with these settings to find out how they impact your overall CGT liability. Talking about strategy, I'll go through 5 common scenarios on how you can use this report for tax planning. The first one is tax loss selling. The primary goal of tax loss selling is to offset capital gains from another investments or to reduce the overall gains. For example, if you bought a stock for $10,000, now it is worth $28,000, so you decide to sell it because you think the share price has run ahead of the fundamentals. But now you have a CGT liability of $18,000. You might discover that you have some stocks sitting at a loss for many years that you want to remove from your portfolio. So you decide to sell them to reduce your capital gain tax for the current financial year. It is common to gradually increase your investments in a stocks over the years as the business prospect improve. But when it comes to selling the shares, the challenge is always which parcels should I sell? Is there the best times to sell to optimize tax liability? You can answer those questions with this report. As an example, if I want to sell some of my CBA shares, this report tells me which parcels qualify for CGT discount and what are their respective tax liability, so I can work out which sales allocation method will achieve the best outcome for me. Another scenario is the portfolio drawdown. Let's say you want to draw down $3,000 from your portfolio every month, and you want to know what is the best way to achieve this in the most tax efficient outcome. You can use this report to identify which stock to sell first based on their cost basis, holding period, and current market value to optimize your drawdown strategy. For example, you might prioritize selling assets that have a higher cost basis or those held for more than a year to take advantage of lower tax rates, thereby minimizing your overall CGT liability while drawing down the required amount each month. Another scenario similar to portfolio drawdown is retirement planning. As you approach retirement, you might review your finances and come up with a drawdown strategy that includes both your superannuation and your investment portfolio. This strategy ensures that you have a sustainable income throughout your retirement while optimizing for tax efficiency. In the process of retirement planning, you might also consider estate planning. So for example, the tax implication on gifting and inheritance. Again, this report is a good starting point to understand how all of this would impact your overall financial strategy. Last one is the portfolio rebalancing strategy. For example, you notice in the diversity report that your portfolio is overweight on the tech industry, so you want to rebalance your portfolio without incurring significant tax liability. You can use this report to select stocks that have the smallest gain or even losses to sell, reinvest those proceeds into another industry to achieve the desired portfolio diversification. In conclusion, the Unrealized CGT report can offer insights into tax planning strategy across various scenarios. Whether you're considering tax loss selling, optimizing your CGT impact before selling your shares, drawdown from your portfolio, planning for retirement, or rebalancing your portfolios, this report can help you in making better tax decisions. If you have any questions, feel free to comment down below or ask us through our website, and I'll see you all in the next video. Bye.